for joining our webinar. It is our Spring Outlook webinar recorded here on Tuesday night, March the 6th. And again, thank you for joining us. If you are live joining us, we appreciate you being here. There's a chat box that you can type a question into. You will not be able to use any type of audio device to communicate, but there is a chat room. You can send me a question. I will try and answer it. If you're joining us on demand through our website at a later date, you can always reach out to any of our agents around the Midwest, and they would be glad to answer your questions that you may have. But again, we appreciate you being here to join us. Kind of give you the disclaimer, get that out of the way before we get too more involved in the presentation. So this is a free webinar for clients, subscribers alike, and we do this about once a month. We also do something similar every morning of the trade, where we do a very quick, we call it Market Insider TV, where we look at the headlines of the market, what things are going to be taking place, what the market's trading on. Do that on a very short video feed, 4 to 5 minutes, and we do that every morning. And you do need to be subscribed to us to be able to watch that. So if you're not currently receiving that via email, please let me know and we'll get that change made. All right, if you're new to our company, we do full service brokerage. We have 12 licensed brokers and been in business over 16 years now. We have offices in, I believe, 10 different states: Missouri, 2 offices in Iowa, Yankton, South Dakota, Omaha, Nebraska, 2 offices in Minnesota, North Dakota, Montana, and our newest office in Illinois. And our clearing firm is R.J. O'Brien. They are the oldest clearing firm on the Mercantile Exchange, founded in 1914. So there's a list of services that are available through our company, and full discount brokerage services. We have our Market Solutions Head program, where you can become a full service or discounted service there. Trading platforms, market quotes available through R.J. O'Brien, and a host of newsletters. Our trader newsletter, a weekly newsletter, a daily newsletter, and of course our Market Insider TV that we had mentioned, our text service and our Twitter feed, and much more from our company. I'm going to talk first a little bit about going into the spring, the importance and how to develop a marketing plan. We have our own hedge program that we run through our company, and this is a newsletter with text service recommendations. So the newsletter comes out about once a week. It highlights corn, soybeans, and wheat. We break it up between spring wheat and winter wheat, as they are different commodities, have different seasonalities, different trading patterns, different fundamentals, and we do our best recommendations as far as making cash sales, re-ownership opportunities, hedging, and we also supplement the weekly newsletter with text recommendations. So if you want to receive that, we can certainly set you up on a subscription to this. And if you would like more of a full service, where we contact you with recommendations, with a phone call, talk you through maybe the why we are doing something, in explanation, that is a full service package that is also available. We focus on fundamentals for direction, technicals, and for sales and re-ownership opportunities. We do have very competitive fees. There's a very minimal cost to do the newsletter text service, and a very reasonable cost as well for more of the full service plan. And I used to be in ag lending, and so I set this program up from that perspective. It's a program you can take to your banker, as it does reduce risk. And you know, I know a lot of times right now things are kind of tight as far as margins. Talk with many bankers, and they have expressed that to me, that they wish more of their clients would take time to develop a written marketing program. Our plan seeks out long-term marketing opportunities. We've talked with clients in the last couple of weeks about potentially this as being a marketing opportunity. They don't come around all that often. We've had, last year had one for just a few weeks, and you had to be pretty quick on the trigger to do anything this year. Maybe this opportunity is coming a little bit earlier than what a lot would expect it to be. So as you look at developing your own plan, make sure you write it down and stick to it. It's too easy to go with a plan, not be able to look back on it and kind of veer off track. When I first started in the company and the business back in the mid 90s, I was with a different company, but I went to a marketing seminar held by someone else. I won't say who it was, but back in the day, corn was probably trading at 215 or 220, so that tells you how long ago this was. And their comment going into the summer was they had no reason why corn would ever get to 240, but if it ever did, you had to sell at that price because there's no way that we would sustain that price. And prices did start to move higher, a little bit of a drought scare in the summer. Prices got to about 235, and that same person said not to make any sales, changed their orders, and the high of the year was 245. So if he would have stuck to his original plan, would have been selling within a nickel of the high of the year. And unfortunately, that didn't happen. They did not stick with the plan that they had written down. It was a good plan to be in the beginning. Other things to note, aggressiveness relates to time of the year. We're in right now in a situation where we don't have any of our United States crop being threatened because none of it's been planted yet. So you don't have to be real aggressive, I don't think, as far as making sales. But as you get into the spring and into the summer months, it becomes much more important to become more aggressive as far as sales and your hedge positions. If you're still working off of 2017 crop, your window for marketing that is starting to close. You've got 3 or 4 months to market yet versus the 2018 crop. You've got all this summer through next winter into the summer months. You've got a long time to market, so you don't have to be quite as aggressive on that new crop marketing because you do have more time. You also need to manage your risk. A lot of the plans don't manage risk. In fact, they encourage you as a producer to take on more risk, maybe making hedge sales without any recognition of reownership strategies or how to manage the risk. If you're selling corn at $4 and it goes to $6, how are you going to manage that risk? Vice versa, if you're not making any sales now, how do you manage the downside risk if this is our one and best marketing opportunity? Got to find those marketing opportunities. So we've had over $1 rally off our lows in soybeans. That certainly qualifies as a marketing opportunity. For wheat producers, we've had a near $1 rally in the winter wheat contracts. Again, that should represent a marketing opportunity. When a market moves like it has, given the overall fundamental picture, that is certainly warranting a marketing opportunity. Base your decisions off of fundamentals, the technicals, seasonals, and risk management. Don't go off of emotions. If sometimes a gut feel is as good as anything else, but have reasons to justify your actions rather than just a snap judgment or a snap rush to make a sale or be forced that you have to do something. Let's talk about corn fundamentals here. These are last month's numbers, and a lot of the things we want to look at is harvested yield is 176. That's not changing from the January number, but what we have is a production number of 14.6 and usage of about 14.595. So really not much room for error in this last growing season because we are using everything that we are producing. And as we go into this upcoming growing season, we're in that same boat. We've got a big cushion here. We've got a lot of ending stocks as our cushion, but we have such a strong demand base that we're going to have to produce a crop of this variety, about 14.6. The year before, we did a 15.1 billion bushel crop as we had just outstanding yields and more acres. But we're in that area now. If we do have where we reduce this yield, we're looking at 13.1, 13.2 crop. Then you're starting to draw these stocks down into a real bullish situation. So that is something that we want to keep in mind as we go forward here in this next marketing year. corn ending stocks, these are some big numbers here. Go look at this last 3 years of stocks, and you go off to this side. You can see we have huge amount of stocks, and only a couple times in history here in 92, 93, and for 1 year here in 04, 05 did we exceed over 2 billion bushels. So we've done it the last 3 years combined. We're definitely due to take this to another place where we're not seeing that many ending stocks. We're not seeing bushels above this 2 billion bushel level, but this is something to keep in mind is we don't stay above this area very long. In fact, we go back in here into 2011 and 12 where we had these drought type years. We drew ending stocks down below 1 billion bushels. It only happened a few times. So we're in kind of a rare area here that the market's becoming used to 2 billion plus bushels of ending stocks. If we would have some type of a weather adversity or drought, we should send prices sharply back higher. Okay, so we look at our corn supply and demand balance sheet, and then also on this side over here, we've got projections for this upcoming year from R.J. O'Brien. So this is for the new crop marketing year. They are looking at a little bit smaller yield compared to a year ago, and they do have total usage in above last year's numbers, so 14.6 usage, and they have production at 14.2. So you can see we're in a pattern here because we've done such a good job with this production that we've got record large or near record large production, but our demand is exceeding that, and that would draw ending stocks down to 2.1 billion bushels. That's not a concern. In fact, you go to this this number here, 14.5 stocks usage ratio. It's one of the largest that we've had in history. The last couple of years, 16, 17, 17, and 18 exceed it, but it is larger than any other years. So even with a small reduction in yield, we're still going to have a big stocks to use ratio number. It's when we get these big yield reductions that we have stocks to usage in the teens, and that's where we can see some real bullish price appreciation going forward. Okay, again, if there's any questions, let me know, and I'd be glad to answer them as we go through this. So I think we're in a situation where the market's kind of everyone's assuming big yields, and if we don't see those big yields, definitely could see prices move back, from these low areas back into more of this $5 to $6 range. Now this is a chart of weekly corn, so we're looking at weekly charts, and what I want to look at here is I've highlighted these boxes that represents the annual highs for the year. We've got 2014, 2015, 2016. Someone's telling me we're not seeing the screen change, and I'm not sure why that is. Let me see if I can change that real quick here. Okay, so hopefully what I did there fixed the problem. If we get a situation where we're okay, so I'm being told that works, so that's helpful. If we get in a situation like that again, just let me know. I'll kind of just back up here real quickly and look at what I was talking about. This was the ending stocks number from the last report. Corn stocks that we talked about here, how we are above 2 billion bushels, and we've only done that a couple times in the last few years of history, 92 and then 04, 05, and we're just one bad crop year away from seeing markets really start to change. As we look at this screen, and it looks like everybody's on the same screen here now. Our carryout is 2.1 billion bushels. This is a projection from RJO. This is a projection I was talking about. They're dropping yields. You can see the production is down a little bit from last year, and it's below total usage. So we are reducing this important number, this carry in or carry out number of 2.1 billion bushels. The key will be is if we can produce this big of a crop. Anything short of that, under 170, and we start to cut in these ending stocks pretty drastically, and that's where you can see big price appreciation. Okay, so here's the chart that I was looking at on the weekly charts. We were talking about when market makes highs. 2012, 2013 was made, 2014, 15, 16, 17. You can see all these years what we have in common is we've made lower highs, lower annual highs than the previous year. And that's because we've increased our yield in each of those years, and we've also increased our ending stocks. The other thing to note is these other boxes on the bottom side, this is our lows. We've made lower lows compared to the previous year, each year. And now we're at a point where we're starting to rally back above this number here, this $4 number. We've got December corn getting close to $4. We've got March corn kind of knocking on the door of you know, in that May corn around that 387 area. Unlikely we're going to get above these highs unless we get some sort of a drought producing year. So as we get prices up into this range, this $4 range, this is an area kind of the sweet spot to protect, to start making sales. And if we get above this area here, that's where prices could get exciting, and we really start to need to protect those areas. And then lastly, this is a December corn chart. This is pretty up to date within the last couple of days. We're sitting 404, 405. Last year's highs was just below 430, around 428. This is an area where we feel that this is a place to get started selling. And I also brought this chart on board here to show a pattern of this commercial index. As you can see, when the commercials get heavily short like they were at this point, this is a lot of times when we'll see a peak in prices. And throughout the fall months, as prices dropped, the commercials were buying. Of course, the funds were selling until they got to a point here where it turned pretty bullish. And that was pretty darn close to where we saw the lows being formed. And prices really never went too much lower from there. As the market started to rally, they started to sell. And now the commercials are holding a fairly sizable net short position as prices have rallied in here. So again, probably more evidence that we need to be looking at making some sales. As you know, the commercials are making sales into this rally. Let's go ahead and try and kind of follow what they're doing as the prices have rallied, start making sales. And you know, we're in that time frame of the year where March is not a critical month, but it is a time where it's not unprecedented, where we could see a high being made in the corn market. All right, so let's look at soybeans. And this is last month's report. In February, USDA increased ending stocks by lowering the exports by 60 million. So it gives us a burdensome 530 million bushels of ending stocks. And as we look at a chart here of our ending stocks, we draw a line at 550. We did it back in 06, 07, but now we've done it back-to-back years here, 17, 18, and RJ O'Brien is projecting we're going to do it again, and we're going to have 650 million bushels of ending stocks. I've seen forecasts from Hightower, and they are looking at about 950 million bushels. This is a 950 million bushels of ending stocks, because they think if yields are big, our demand will slow considerably, and we'll have stocks that'll far and away exceed anything we've ever done in history. So right now we've got the biggest stocks we've ever had in history. We've got a rally going in the soy complex, and we've got expectations we're going to see more acres next year. So I think it sets us up on a bearish mentality, or should have that bearish mentality at least. We made a nice bottom in soybeans on the daily charts, and again, this is we're looking at commercials. If we go back here to last June 17th, when the prices were low, commercials were buying, and prices did rally. Now they sold into that rally, and they didn't get real bearish until about here in November, here in December. Right about there is where prices turned and went south. They got bullish here again in January. And so the prices have rallied now on heavy fund buying and lack of any commercial selling. In fact, they have, or lack of any commercials stepping in front of it. They've gone net short here now. And so I think we're at a point where prices have exceeded the summer highs, which would be about 1030. We're kind of in this area up here around 1040. This may attract some additional acres. It certainly will probably attract it should attract fairly heavy aggressive selling with the projections for big stocks that we have going forward. So, we've got downside risk, I think, to this 930 area, which would be at least $1 going into the fall at a minimum if we can produce a big crop. So, any questions on soybeans, let me know. Otherwise, we're going to look quickly at the wheat market. Okay, so wheat had psychologically a little bit bearish news last month, 1 billion bushels of ending stock, so not much of a change. Exports were down 25 million, but the market is not really focused on that. It's focused on the dry weather in the southern plains, and we've had a big rally off of our lows here in Kansas City wheat. We made lows in December when, again, these commercials were pretty aggressive buyers throughout the winter months, and prices did start to rally. Here they were pretty aggressive sellers as the market had rallied in this time frame. You can see they're sellers once again as the market is rallying. So we're kind of consolidating after a rally from about 435 to 553 area on July. So we've had over $1 rally. We talked earlier about marketing opportunities. This, I think, is a marketing opportunity to go ahead and start making some sales. We've got, this is where we went to last summer. We may be able to push this thing a little bit higher yet, but certainly as we get up to this level, I think your commercial selling is going to increase and producer selling should increase as well. There is plenty of wheat around the world. Once we get this wheat crop to break dormancy, things could change as we start to focus more back on demand trends instead of supply trends. So to summarize, large carryover stocks mandate production for shortfall to reduce inventory. We've not seen much of an inventory reduction yet in the wheat balance sheets because the crop hasn't been harvested yet. It hasn't gone through its reproductive phase. If we would change the weather pattern, and that's a big if at this point, we could have a huge wheat crop. Prices could fall back sharply. I don't look for that to happen right away, but it could happen if the weather pattern changes into April and May. So there's your risk if you're a wheat producer. There's a lot of risk on the downside at this point. If you're a corn and soybean producer, you have to bet on further production shortfalls, and right now we've got one. We've got production shortfall in Argentina and in corn and soybeans. So we got to have this type of production shortfall if we're going to continue to see prices move higher because of large carryover stocks. The drought in Argentina reduces exporter supplies of meal and for corn. That gives us better U.S. export business. Argentina is the world's largest exporter of meal. They export about 34% of the entire world's needs, and the U.S. only does about 11% by contrast. So we are in a position where we should be able to start exporting more soybeans, and we are seeing an increase in soybeans. I look for our balance sheets to tighten up a little bit, but again, if you remember, we were looking at 530 million bushels of stocks. We can tighten it back to 470, and really won't change much in the way of how the market is perceiving the size of the crop. One thing we did talk about, funds going from very net short to very long in this rally. Commercials sold into it. Remember to follow the commercials. These guys, who you want to follow if you're a producer. If they're selling into a rally, you should be selling into a rally as well. So we've got some marketing strategies that we're going to talk about here in a second that will kind of highlight some ways to manage risk and and to follow what we've been talking about as far as managing risk. All right, so marketing strategies, these are some previous ones that we made. Now, we talked in previous webinars when sales are made at harvest, want to look to buy July 380 corn calls and sell the March calls. And the reason we did that was because of the big supplies and lack of really any weather threat should allow those March calls to expire worthless, and they did in both the corn and soybeans. The March calls expired worthless, and that left long July calls because we want these March ones to be worthless. Now, what do we do with these long July calls? I think at this point you've got to liquidate your options or roll them up. And by rolling them up, you can move from a July 1040 bean call, let's say, to maybe a 1080, $11 call, capture some of the profits that you made and still be long. If you want to be bullish, you certainly can. I think at this point there's more risk to the downside than the upside, so I think I would just go ahead and liquidate these. But if you want to roll them up, that would be a strategy. Just go ahead and roll the calls, but at least you captured some of the profit. As far as wheat, if you were storing wheat, we sold calls against stored bushels, figuring that there would be lack of movement. Now, these March calls expired worthless, so we collected the entire 18 cents of profit. So that worked out well. The May wheat calls that we sold for 15, we ended up buying them back for 2 cents when wheat started to move higher. Thought that those calls were a little tight as far as strike price, and they may be in jeopardy. And turns out the wheat market has rallied enough to put them in jeopardy. So it's a good thing we did buy those back and are just flat in those options at this point. Now, here's some strategies going forward. Okay, so what can we do? Right now, manage your risk by selling cash and selling the carry. If you're holding old crop, go ahead and make cash sales, and you can do that. There's still carry in the market, and you can sell cash, generate some cash at one of the higher prices we've seen in the last 12 months. And if you want to remain bullish, buy some calls. Last time I looked, July $4 corn calls are about 14 cents. That would give you a look at the spring. All the way into June 22nd, I believe is the expiration. You can buy July bean calls for 36, and so for about three months of time. So you're looking at for 12-cent risk per month here, and a little over 4 cents on these. You can be long calls and have a look at the upside for the market, and that's if you want to remain bullish. I really think producers need to begin to make new crop corn sales. Now, I highlight here small increments, same thing in soybeans, do small increments. This is a time of year you don't have to be that aggressive. I think it warrants certainly making some sales at this point, but if you wanted to start small, do 5–10% of your crop at this time. I've talked with clients today who are as much as 50 to 75% sold with some of their corn and soybeans already. They have been very aggressive. I think it's early to be that aggressive. We don't know much about this growing season or even summer weather. But you can go ahead and make small incremental sales, but certainly want to be making new crop bean sales and corn sales at this time for the reasons that we talked about. Also, I think it's a good time to start looking at buying some puts. This is an example, December $4 puts. Start over. December $4 puts for 24 cents. 10/20 bean puts for 45, and I wrote behind it, roll up as warranted. That means if we're at $4 here now and corn goes to 4.30, have a strategy in place to roll that protection higher, because as we've seen it many times going into harvest, prices do turn lower. Even if we have a little bit of a shortfall in prices, prices do turn lower. Another way to play these options, a lot of people like to sell calls, buy puts and sell calls. I don't like that going into the growing season because it limits your upside risk. It exposes you to margin calls. What you could do is sell July 10/20 puts for 15 cents, and that would cost you a net of 30. I don't see the same strategy in corn. I just see this as an opportunity in soybeans. Selling a July 10/20 put, July soybeans are at 10.80 roughly right now, 10.78. So you're looking about 60 cents out of the money. if the market would drop 60 cents, these puts would protect against these short options. And if we don't drop to 60 cents by the time July goes off, or these options go off the board June 22nd, you get to keep this entire 15-cent premium. So it's a little bit more risk. It costs you less. There would be no margin calls associated with it. And if we would drop below this strike price and you get exercised, you have these puts to offset it. So there's ways to manage that risk, and I know any of the agents around the country that we have working would love to talk with you about that and explain it to you if you want to. But I don't like selling calls on this rally as we go into the growing season, because I think the price upside potential could be somewhat explosive going into the summer growing season if we were get into a situation where yield are being robbed in corn and soybeans. The stocks numbers are large, yes, but the production, I mean, the demand is there that you absolutely have to have large you have to have a large production this year, or you're going to really cut in those ending stocks and prices could move sharply higher. Okay, anything else? So we'll move into live and feeder cattle. Okay, so that was all that I had there. Okay, so live and feeder cattle, we're going to talk on these markets here real briefly. Again, if you have any questions, type that in the message box, and I would be glad to share that with you. Let's look at our U.S. beef production for the last 3 years, and you notice 2017 was largest ever in history, and if we would add 2018, we're going to be just a little bit above it. So we're going to have more production this year than what we've had in past years. So 2018 is we're going to have more supplies. You've seen our cattle on feed reports recently, and they suggest that we're going to have bigger supplies in 2018 than what we did a year ago. Consistently, our placements have ran from 9 to 14% larger. Our on-feed numbers are 7 to 8% larger than a year ago. Cattle on feed here, this does have 2018. It does show you pretty clearly we've got more cattle on feed than at any time ever in history. What saved us last year as far as prices being good was this blue line, 2017 demand. It was pretty much average until we went into this last half of the year. And then as we got into this time frame, October, November, it really spiked higher. We went well above the 5-year average, which is this red line, and that is due to Brazil pulling out of the export market. Now they are set to resume beef exports once again, and that could cut into our U.S. export market, and that would be a bad thing for us to happen. We are running about 10% above last year. So last year, this blue line right in this time frame was above the 5-year average. We're running a little bit above it, but not this much higher. We're just a little bit, 10% increase, and that's positive and helping us sustain prices. The concern would be is if we don't have strong demand, we're going to see prices move sharply lower here. So exports exceeded production by a record amount in 2017. We'll need similar demand as our 18 production increases. So currently 10% better. We need to maintain this pace going forward. Risk of summer lows at about $95 if demand is soft. And cattle for summer months, June cattle closed today at about 114, so there may be $20 of downside risk. We probably are going to have some weakness in the cattle market on the opening tomorrow morning due to what's happening in the stock market tonight. So I wouldn't be surprised to see the cattle market work its way sharply lower on the open. Upside potential, if we really have really strong demand, probably 130 range. So, doing something, protecting June cattle anywhere from 115 to 120 and above using some put options or some option strategies makes a lot of sense. And for feeders, downside risk is 124 for the summer months. I was pricing some September feeders for clients today. we did some today at 154. And that's really where we think upside potential is 155 is our upside potential with downside risk of about $30 from where we're currently at. So I do expect there's going to be a lot of volatility in the cattle market going forward into the summer. So unless anyone has any questions, that is going to be the end of my presentation tonight. I do thank you for being in attendance and participating. Hope this was informative and that you will look at doing some risk management going forward here in 2018. I think there could be some very potential bullish implications in corn and soybeans given the right weather scenarios. And if we do get in a drought type market, owning call options can be a real bullish situation for you. So have a good night, everybody. Thanks so much, and contact any of our agents. They'd be glad to talk with you about marketing strategies.